I want to welcome everyone to this special topic webinar this Thursday. I'm really excited to welcome our presenters from Charter School Business Management, PKF O'Connor Davies, and Mengel Metzger Bar and Company to present to us on information related to some of the new lease standards that apply to charter schools. So I'm going to be very brief here at the introduction, but I do want to let people know that if you have questions throughout our presentation, please feel free to add them to our chat. We'll keep a running total of those questions and we'll answer them after the presentation. So without further ado, I'm going to turn it over to Sharon Denson from Charter School Business Management to welcome our presenters and to begin our presentation.
Good afternoon, everybody. Thank you, Michael, and thank you to the New York Charter Schools Association for allowing us to share this important topic with you today. I'm Sharon Denson. I am the CFO of Charter School Business Management. Presenting with me today will be Lola Barbarash, Director, also from Charter School Business Management. From Mengel Metzger Bar and Company are Michelle Kane, Partner, and Kevin Cox, Senior Manager. And from PKF O'Connor Davies are Gus Saliba, Partner, and Daniel Smolin, Manager. Okay, so today we're going to discuss the new lease standard, ASC 842, that I know we are all anxiously awaiting to implement on July 1st. I just want to start out by saying this is a very complex topic that has a lot of nuances, and it would really take hours to really do it justice. Today, since we only have an hour, our intention is to provide you with an overview of the requirements and the steps that you will need to aid you in your transition. And because it's such a complex topic, we want to get through everything. And as Michael was saying earlier, we're going to ask you to just type your questions in, and we'll review them at the end. We'll also provide you with a Q&A sheet along with a PDF of the presentation, so you have both for future reference, because it's a lot to swallow here. So here's our agenda. If you can go back to the agenda, please. Sorry. We want to spend the bulk of our time on examples. So I will start out with a brief overview of the new standard. Then we'll get into the transition steps, starting with Lola, who will go into inventorying and reviewing your leases. And then Daniel and Kevin will get into lease recognition and measurement using sample equipment and facilities leases. Then Gus will cover common questions and things to consider, and Michelle will wrap it up with any question and answers. Okay? So why the change? So the current standard 840 doesn't provide a full picture of an organization's liabilities, since the future lease payments for operating leases were not reflected on the balance sheet. So ASC 842 was implemented to rectify this by requiring operating leases be recorded on the balance sheet, giving stakeholders a complete picture of an organization's lease obligations and their true financial position. Okay, next slide. So under 842, we're still required to classify leases as either an operating or a finance lease, which was formerly a capital lease under 840. A lease is considered to be a finance lease if it meets one or more of these conditions. If the title transfers to the lessee at the end of a lease term, or if there's a purchase option at the end of a lease that the lessee is likely to exercise, if the lease term is for the majority of the asset's remaining useful life, or if the present value of the lease payments is substantially all of the asset's fair market value, or finally, if the asset is so specialized that it can only be used by the lessee. So if it meets one or more of these conditions, then it's considered a finance lease. If none of them are met, then it's considered an operating lease. Okay, next slide. So this slide gives you a side-by-side comparison of the old and the new lease standard. We've included this for your reference, so you can go back and look at it later. But before I go to the next slide, there are just a couple of things that I wanted to highlight about the new standard. So 842 introduces the concept of lease and non-lease components. So a service agreement or a contract can include the use of an asset that is considered a lease component under the new standard. Then there are goods or services included in a lease that are separate from the asset itself, which are classified as non-lease components. So that's just something that you need to keep in mind as you're reviewing your leases. And then overall, any leases that are 12 months or longer must apply the standard. But in addition to that, if you have any leases that are less than 12 months that have a purchase option that is likely to be exercised, you must also apply the standard. Okay. Next slide. So this slide basically just shows you how the two lease types are presented on the financial statements. So for the finance lease, you will have a right of use asset and a corresponding liability on the statement of financial position. And you will have amortization of that right to use asset as well as interest expense on the liability on this statement of activities. And then for the operating lease, you will have that same right of use asset with the corresponding liability on the statement of financial position. And then on the statement of activities, you will have a lease expense. Okay, and you'll see this in action when Kevin and Dan actually go through the examples. All right, so that's just a quick overview. I'm going to turn it over now to Lola, who will go through the transition steps.
Thank you, Sharon. Good afternoon, everyone. So this is a quick overview, very high level of what this implementation looks. It looks like 4 steps, looks pretty much easy to do, but I will warn you, this is time consuming. That's why we're having an early start on this. I think in some ways we might be a bit late on this. Step 1 and 2, from my experience, is the most time consuming. This is where we're collecting all the leases. If you're working with auditors or consultants on this, this is where we need the most updated final lease with the vendor. We're gonna mention throughout the presentation leases and contracts, as Sharon mentioned. Some contracts do have embedded leases in them. One good example of a contract is your security contract. Some security companies provide actual equipment. Same thing with your custodial contracts. Some custodials provide things as small things as a soap dispenser. That is a tangible asset that is considered an embedded lease. So we need not just the leases for your copier, or your water lease, it's any contracts that have embedded assets in them. So once all those leases are collected, you are documenting this process in step 2. You're reading through the entire lease. Some leases are very long, and collecting key information that will be needed for step 3 and 4 on how to calculate it, what approach is best for the school on how we were going to recognize it. Once we do all the calculations, that's when it is entered in your accounting software, and then we could present reports. So on the next step, I'm going to go a little more into detail on what step 1 and 2 means. So going through your general ledger, you're going to identify what are your recurring payments. What are some of the payments you're paying now? What are the leases? You're going to most likely you're going to be calling vendors to get the most updated lease, because there might be multiple versions of those leases. One request that we do call the vendors, we ask for the interest rate. Part of the calculations that Kevin and Dan will mention is we need an interest rate. A lot of equipment leases that are presented, sometimes that interest rate is missing in the document, so the vendor will have to provide that information. If they don't, there's other ways to get interest rates, but we recommend please attempt to reach out to your vendor to get that information. So part of that also is now documenting once you analyze the whole entire lease. So on the next slide, you will see a quick sample of what the lease inventory looks like. Key information that we need is who's the vendor? What are we leasing from them? doesn't have a purchase option. All leases will either state, yes, there's a purchase option, they'll provide a value, or there is no purchase option. Then you're going to identify if it's a finance or operating lease. Each one has its own agendas or guidelines that you would need to identify that. How often you pay for that lease, what are the payments, when did the contract start, since we need to know if this is a 12-month contract or longer, the interest rate on that. And one thing I forgot to mention is if there's an option to extend, that would affect your calculation. And also, how reasonable are you going to extend it? And also if you're going to be purchasing towards the end of the lease. All this information is required in order to move on to step 3 and 4, which I will pass it on to Kevin.
Thanks, Lola. So now that we've taken inventory of our leases, we'll get into some of the implementation and accounting for the new standard. Before we get into that, though, it's important to recognize what's really driving the numbers here, and that's the net present value of the future payments for your lease. Lola talked about the interest rate a moment ago and the importance of that. For lessees, the implicit rate in the lease agreement is going to be used, but if you can't use that, you'll use the incremental borrowing rate. So that's just the cost of financing a related good. Now, for many charter schools, they'll be able to use a practical expedient that non-public entities can use. And this says that you can use the risk-free discount rate instead of the incremental borrowing rate. Now, mind you, if your school has conduit debt or public bonds, you're considered a public organization, so you can't use this route. But this will work for many charter schools. Also keep in mind that using the risk-free rate is generally going to lead to a larger right-of-use asset and lease liability, just because it's traditionally a lower borrowing rate. So keep that in mind when you're going to account for whether or not it's a financing lease or an operating lease. We'll skip ahead to the next slide, slide 12. So let's talk about a lease liability and a right of use asset. What does this mean? So a lease liability is going to be the present value of your unpaid lease payments. So that's driven by your net present value calculation. Your right of use asset is going to be a corresponding or offsetting amount on your balance sheet. You'll have your lease liability plus any initial direct costs, any prepaid lease payments, less any lease incentives received. Now, I'm going to go through a simple equipment lease example, really basic. In this example, you're going to see the initial measurement of the right of use asset and liability. They're going to equal each other. As the lease progresses, you'll have a right of use asset is going to be defined as your beginning balance less any accumulated amortization through that period. On the next slide, you'll see just some basic terms for our lease. We've got a July 1st, 2021 start date, so a year before implementation. 3-year lease, no option to extend, fair value of $90,000. Our lease payments are $1,800 a month, and we've determined that it's going to be an operating lease. For our interest rate, we're going to take that practical expedient and use the risk-free discount rate. So on the next slide here, you'll see where we pulled our discount rate from. Online, the U.S. Department of Treasury provides daily Treasury par yield curve rates. It's important to note that as of implementation date of July 1st, you're going to use the remaining term on your lease. So remember that our lease started a year ahead of implementation date, but because there's 2 years left, we'll use a similar 2-year rate. We'll also use, we're not at July 1st, 2022 yet. But that would be the date that you use your interest rate from. So for our purposes, we'll use the rate of 2.75% from a couple days ago. So you'll see we already achieved step 1. We've determined our interest rate. Step 2 is going to be taking a look at our future payments. Step 3 on the next slide. We'll aggregate these payments and come up with a summary of what we expect to pay. And then we'll compare that to the net present value of the future payments. A couple more definitions: accretion of the lease liability. So this is going to be akin to an interest portion. If you have traditional debt, you make a monthly payment that is comprised of principal and interest. So this is kind of similar. You've got the prior month's ending lease balance times the discount rate divided by 12 months. And this accretion is going to decrease over the term of the lease like an interest portion of a payment would. Your periodic lease cost is going to be just your straight line rent expense. So for our purposes, we've got $1,800 a month. On the next slide, what does this mean for accounting and seeing the progression of the different balances? So we've got our initial lease liability beginning balance. We're going to reduce that by any monthly payments. We're going to add back the accretion of the lease liability, and that'll get us to an ending balance. For the right of use asset, we've got our initial balance. We're going to reduce it by the periodic lease costs and then add back the accretion of the lease liability to get to an ending balance for the right of use asset. So I'm sure everyone's dying to see, what does this look like on a spreadsheet? Here's a quick example of our lease. You can see we've run it from the beginning date of the lease. So initially, our net present value calculation shows us that the future value of the payments is $62,131. Our implementation date, though, is going to be on 7/1/2022. And you can see that at that point in time, we've got an initial balance of $41,987. Also on the schedule, you'll see consistent periodic lease costs, consistent payments, and you can see the impact of the accretion of the lease liability on both the right of use asset and the lease liability closing balance from month to month. If we go to the next slide, you can see over the course of the lease, we've paid out $64,800. We have both the right of use asset and the lease liability coming down to a zero balance by the end of the lease. Now let's talk journal entries. So we saw that $41,987. So for our implementation date of July 1st, we're just going to have a balance sheet only entry. We're going to debit our right of use asset for $41,987. We'll credit our lease liability for that same amount. So balance sheet impact only. On the next slide, we'll see our monthly impact. So to record our first month's cash payments, we'll debit our lease liability for $1,800, credit cash for that same amount. We'll debit lease expense for that periodic cost, the $1,800. Our credit to the right of use asset is only going to be the $1,704, so net of that accretion portion, and we're going to credit the lease liability for that accretion portion of the $96. Now, as we talked about a moment ago, as the term of the lease runs through, your credit to the right of use asset and lease liability there are going to change slightly depending on where you are in the term of your lease. So for that first lease year that we've been accounting for this, we can see that the lease expense is unchanged, which is expected considering the entries above. We've got cash outflows of $21,600 and a total impact for the lease liability of $20,705 and a reduction in the right of use asset by that same amount for $20,705. So from a P&L perspective, really, we're not seeing any impact pre-ASC 842 implementation to post, just for this simple example, but just keep note of that. And on this slide here, this isn't what your statements are going to look like, but you can see in 2022, this is what your statement would have looked like prior to implementation. We don't have any right of use asset or lease liability on your balance sheet. Going forward, you're going to see that right of use asset and lease liability grossing up your balance sheet. Certainly, if you have debt covenants, this is going to impact that, but Gus will get into that a little bit later. But this is just a real quick example of the implementing an equipment lease example. I'll turn it over to Dan now, who's going to go through a facilities lease example.
Okay, great. Thank you, Kevin. Yeah, I'm going to go over a sample facilities lease transition for a charter school. I'm going to walk through what that looks like for a school that had a facility lease in years prior to the implementation date of 7/1/22, and that would have a deferred rent balance on their balance sheet. Okay, so this is just an overview of the sample lease agreement that we're going to be looking at for this example. This is basically just this is a pretty standard building lease for a school. It's a lease for school and office space, 30-year lease term, one option to extend, not reasonably certain to extend. It is an operating lease. The total lease payments for the lease are $24.3 million. And we see that the lease commenced on July 1st, 2017. So it commenced 5 years prior to the adoption date. And the school has been straight lining the rent expense in this example, and will have a deferred rent balance on the preceding year's balance sheet. Okay, this has been covered before. What is a lease liability and an ROU asset? I won't really reiterate what's what an ROU asset and lease liability is. Similar to Kevin's example, we're going to be we have to determine what the discount rate is before we can measure the lease liability and the ROU asset. Similar to Kevin's example, we're going to start with the lease liability. That's really where the calculation starts from. And then from there, we can determine the measurement of the ROU asset. So we would base the interest rate as of 7/1/22, but we don't have that yet. So we're just going to go with the percentage rate that we have. So we're going to add up all of the unpaid lease payments, sum that up into a column in a spreadsheet, and then we're going to present value that. So on the next slide, we can see when we do the present value calculation at 2.86%, the present value of the future of the unpaid lease payments as of the adoption date, as of 7/1/22, is $14.6 million. So that's the number that's going to be the lease liability. That's going to be going on the balance sheet as part of the implementation. Okay, and this just summarizes the present value number. You see we have 21.1 million in future unpaid rent payments, less the 6.4 million PV discount, gives us the present value of 14.6 million for lease liabilities. From there, we can determine the amount of the ROU asset. So as a refresher, the ROU asset is the lease liability plus and minus these adjustments on the slide here. So this is where the deferred rent balance is going to be written off, is against the ROU asset. So we're going to take the 14.6 lease liability that we calculated, and then we're going to write off the deferred rent liability balance at 6/30/22, which is at 808,000, to give us a final number of 13.8 million. Which is going to be the ROU asset that's going to go on the balance sheet at the beginning of the year. Okay, so now that we have the opening balances for the lease liability and the ROU asset at 7/1/22, we can go ahead and prepare a amortization schedule. This 842 amortization schedule that you're going to prepare, it's essentially going to be replacing your deferred rent schedule that you have, because there's no more deferred rent under the new standard. You won't be relying on that schedule, on the deferred rent schedule, for your entries. You're going to be creating a new 842 amortization schedule that you're going to use for your entries. So we're going to start with the monthly payments that we're using for the lease liability, and we're going to add some columns to that and do our calculations. So we can go ahead and go to the next slide. So this is what the amortization table looks like. Very, very similar to Kevin's. So I'm not going to go through every calculation here, but you can see on the left-hand side, the lease liability is wound down through the monthly cash payments that total 21.1 million. And then what's going to be added back to that is the accretion of the lease liability of the 6.4 million present value discount. And then on the right-hand side, the ROU asset, is going to be decreased by the offset of the rent straight lining and the amortization of the deferred rent, and then the accretion of the interest is going to be added back to the ROU asset. So we can see on the bottom the 21.1 million of the lease payments that we were looking at before, and also the 808,000 deferred rent liability, where that goes, and we're seeing that being amortized on a straight line basis through the lease term. Okay, these are essentially the same calculations that Kevin covered, so I'm not going to go through these. Just one thing to mention with the new 842, like what Kevin was saying before, no impact to the P&L, the statement of activities, the statement of functional expenses. In this example, because it's just a transition from 840 to 842 with no other modifications to the lease, it's just going to be a balance sheet entry. There's going to be no impact on the P&L. This slide also shows the movements between the liability and the asset accounts. Okay, so now that we have the opening balances for the ROU asset and the ROU liability, and we have our amortization schedule for those two items, now we can start looking at the journal entries. So at the bottom of this slide, we have the journal entry to recognize the ROU asset and liability as of the adoption date of 842. So we can see we're debiting the ROU asset of 14.6 million, which is just the present value of the lease liability payments, and we're crediting the lease liability for the same amount. And that's how we're going to establish the ROU asset and then the lease liability. The second piece to that entry is, sorry, can you go back? Thank you. The second piece to that entry is the write-off of the deferred rent. The deferred rent balance of 808,000 is going to be zeroed out against the ROU asset, and that's going to be included in the initial entry as well. And this slide shows what the journal entries are going to look like for the fiscal year ended 2023, the first year that the 842 will be in effect. These entries should be made on a monthly basis. We presented it annually here just for simplicity, but you do want to keep in mind the quarterly reports to the that are due to the authorizers. I saw there's a question in chat about that will be addressed later on, but just something to keep in mind with that. So I just want to cover these entries, where these numbers come from. The first entry is pretty straightforward. That's just to record the cash payments made per the lease agreement. Under this example lease agreement, 700,000 was due in monthly installments for the year. So we're going to debit the lease liability for that amount and credit the cash for that amount. And obviously the amount in that entry will change every year as the monthly rent payments change every year. The second entry is to record the periodic lease cost, or the otherwise known as the rent expense. This is this is to record the P&L, the rent expense, and to adjust the ROU asset and liability for that amount. So the rent expense of 811,000 is on a straight line basis. That's going to be the same exact straight line rent expense amount that the school has been recording in previous years under this lease. So the straight line rent expense will not change. That's going to stay the same. And what that number is the offset of the future payments due under the lease of the 21.1 million straight line, offset by the deferred rent balance of 808,000 straight lined over the term of the lease. The offset between those two is the rent straight line. The credit to the ROU asset is the amortization. That number is the straight line rent expense of 811,000 minus the 416,000 interest accretion being recorded to the ROU asset and the lease liability. And then the 416 on the bottom, that comes straight from the amortization schedule, and that's just the accretion of the lease liability for the 12 months of the year. So the 811,000 debit to rent expense, that's going to stay the same every year. But as the years go on, the credits to the ROU asset and lease liability are going to change as the present value interest changes. So the total credits for each annual entry is going to always add up to the same amount, 811,000. Just the allocation between them will change a little bit based on the PV discount. Okay, and this slide is just like a high-level kind of summary of some of the numbers that we're looking at. This rolls forward the balances in the sample school that we're looking at from the beginning of the year to the end of the year. So we can see at 7/1/22, the school had $1 million in cash, and they had a deferred rent balance of $800,000. The next line down, you see that we are recording the right of use asset and the lease liability of $14.6 million each. That's based on the present value of the lease liabilities. And then below that, you see where we're going to adjust the deferred rent. It's going to be written off to zero in the deferred rent column. And then the ROU asset is also going to be decreased by that amount to give us an opening balance of the ROU asset for $13.8 million and lease liability balance on the balance sheet of $14.6 million. And from there below, we just see the movement in the accounts through the year. Basically, this is a summary of the journal entries that we were just looking at. We see cash is decreased by $700,000 for lease payments, and that's also going to decrease the lease liability. The ROU asset is amortized at $395,000. That number is the offset of the straight line rent expense and the accretion of the lease liability. And finally, on the bottom is the accretion of the lease liability of $416,000. And we can see all the way to the right-hand side, rent expense. When we add the ROU asset amortization and the accretion of the lease liability, that gives us the straight line rent expense. So you can see it's theoretically similar to straight lining rent under the old standards, the added component of the present value discount and the interest that has to be calculated and then added back to the balance sheet accounts. But I do want to point out just quickly that again, the recognition for this standard under this example with an opening deferred rent balance is just a balance sheet adjustment. You can see there's no impact on the P&L or opening net assets in this example. Just as a check during the year-end close, I just want to check that the ending balances on the amortization table agree to the general ledger. Okay, so we covered the calculation of the lease liability and the ROU asset and what the journal entries look like during the year. So what are the financial statements and the disclosures going to look like? Here's a sample balance sheet for this example school showing year-ended 2023 and 2022 as kind of a before and after of the new lease standard and the old lease standard. So we can see deferred rent totals $808,000 on here for 2022. And in 2023, you see that those are eliminated. There's no longer deferred rent on the balance sheet under the new lease standard. And now there is the right of use asset of ending balance of 13.4 million and the lease liability short-term and current portion. And just as I said before, right of use asset, there's no short-term portion. That's all going to be long-term. But with the lease liability, if you do have a classified balance sheet with current liabilities and non-current liabilities, the lease liability will be broken out for the current portion on the balance sheet. Go to the next slide, please. Thank you. Just to reiterate in this example, no effect on the statement of activities from the P&L or the statement of functional expenses, just a balance sheet adjustment. I'm going to talk a little bit about the required note disclosures under the new lease standard. The first set here are pretty similar to the old standard. You're required to include a general description of the leases, options to extend or terminate the lease, covenants, So that's pretty not too different from the old standard. When we go to the next slide, we can see a few new disclosures under the new lease standard. The disclose the determination of whether a contract contains a lease, the determination of the discount rate for the lease, and on the bottom here, basically what that's saying is that operating and finance leases have to be segregated on the financial statements and in the footnotes. Here's just a few more disclosures that are required. The two ones that I want to point out are weighted average remaining lease term and weighted average discount rate. Those have to be calculated if there's more than one lease. The remaining lease term and the discount rate have to be calculated using a weighted average and disclosed in the footnotes. These are just example footnote disclosures showing the ending balances of the ROU asset and the lease liability and the weighted averages of the remaining lease term and discount rate. And this slide is another example footnote disclosure just showing the future minimum lease payments, what that would look like. And you can see here the operating lease cost, $811,000 is the same for both years, both pre and post 842. All right, so I'm going to speak about a few points to keep in mind here with this transition to the new lease standard. One thing to mention is that the example that we went through applied the new lease standard at the effective date, which would be 7/1/22. But in addition to this method, there's also another option where the financial statements would be presented comparatively under the new lease standard. What that means is that the comparative periods would be adjusted and the prior period balances for the ROU asset and lease liability would be shown on the balance sheet. That's an option. Just for simplicity's sake, we just showed the single year presentation here. Again, finance operating leases have to be segregated. One important thing I want to point out is so we walked through examples for lessees. Some schools may have friends of organizations where they're also the lessor, where they're subleasing building space to the school. So just one important thing to point out here is that the accounting and presentation and disclosures for lessors are not significantly affected by the ASC 842. For example, if you have a friends of organization with a deferred rent receivable on your books, you're still going to have a deferred rent receivable under the new lease standard. This is really more of a significant impact to the lessees, not so much for the lessors. Lessees can elect not to recognize leases with a lease term of 12 months or less. Just want to say about the calculators, auditors, CSBM, your back office provider, and AICPA. We all have ASC calculators that we're more than happy to share. So just feel free to reach out to any of us, and we're happy to provide those to you. Okay, I'm going to cover some of the practical expedients that are allowed in the new lease standard. What a practical expedient is basically an accounting policy election that allows organizations to kind of ease the burden of new accounting pronouncements, such as this one, just to kind of make it a little bit easier. So the first one is a package of 3 practical expedients. This package has to be elected and applied consistently as a package, meaning all 3 of these practical expedients have to be elected by the school and they have to be applied to all of the leases. So you can either apply it to all of the leases or to none of them. These are just some basic things around 842, assessing whether or not a contract actually contains a lease, the classification, if it's operating or finance. That's a practical expedient for schools to have. A couple more practical expedients. The first one, hindsight, I won't go into too much. It has to do with determining the lease term lease extensions. This also has to be applied to either all leases or none. And finally, non-lease components as well. There's practical expedient election for non-lease components as well. We're going to talk a little bit about finance leases. We didn't really cover finance leases too much because the simple reason that finance leases haven't really changed too much from the new standard into the new standard from the old lease standard. There are some changes to finance leases. They don't have bright line tests anymore where they would have 75% or 90%. Instead, they use terms like substantially all, major part, and reasonably certain to kind of introduce a little bit more judgment into the assessment of finance versus operating. There's a new test this year, an alternative use test, and finance leases are subject to the disclosure requirements under the new lease standard 842. One thing, again, just to remind everyone that operating leases and finance leases are segregated in the financial statements under the new lease standard. Okay, and with that, I'm going to give it over to Gus.
Thanks, Dan. So I'll go through this real quick, and we'd like to save some room to save some time to answer some questions. And I do want to give SUNY's on the line. I do want to give Barb and Connor some time to discuss from their perspective as well. Again, we've been talking about these. I'm not going to go into every single Q&A here, but we'll discuss some. When should we start this? We've been talking about this for about 10 years, but we've been heavily talking to boards. That the standard got extended because of COVID. We've been talking to boards for the last 2 or 3 years or so to start taking inventory, to really just get a spreadsheet together, take inventory of all your leases, really decide what discount rate to use, because it has a big impact on what discount rate that is used in the financial statements. It affects the numbers. It can make the numbers and assets and liabilities go up and down. And also during this process, reach out to your back office providers like CSBM, reach out to your auditors with some questions that may come up. This webinar is not intended to cover every single question, but we will, we will issue a Q&A for questions that we couldn't get to, or to clarify questions that people have on this. So start now, start looking at it now, start putting together, journal entries, putting together present value. We are going to also provide a calculator, in each, auditing firms. I know MMB does have one. So do we. We have our own calculator. The AICPA has a calculator. We can share that with you as well. But start now. Others, we talked a little about Kevin talked a little bit about the covenants and ratios and that kind of thing. So, we have a lot of clients, whether they're CMOs, whether they're schools, friends of organizations that have certain covenants that they must meet, and they have to be in compliance. So once you have that initial recognition where you're recording the asset and the liability, look at your covenants, see if that's going to affect your covenants or not. If it's going to affect your covenants, you should reach out to your lender, your landlord, whoever it may be that has those covenants, and try to renegotiate those covenants so you're in compliance. Most of them will not be affected by this change, but we do have some. We have some clients that have anywhere from 8 to 10 covenants for each entity. So just be careful, do that work on the front end. Also, just to get into the authorizer perspective, again, I thought there was a question that was presented earlier in the chat box about the effective date. It is effective for year ending June 30, 2023. And it is the ASU is also effective for fiscal years beginning after For interim periods, there was a question about interim periods. It is effective for fiscal years beginning after December 15, 2022. So the standard does give you that you don't have to do the interim period until FY 24. But I believe from discussions with SUNY, discussions with other authorizers, they would like to see those implemented in FY 23. And those are usually, they want to see that in your balance sheet or statement of financial position. That is usually the first quarter is due November 1st. So I think we're advising our clients to have that ready, starting with July 1st, recording the asset and liability and have it implemented by November 1st when they have to submit their first quarter to the authorizers. We can go to the next slide, but at this point, I'd like to just invite Barb Ackenauer from SUNY, just to say a few things from the authoriser's perspective. I know she can be a little lenient sometimes on some of this, so I'd like to invite Barb to speak about that.
Thanks, Gus. And yes, we are lenient, and we are always here to work with the charters. We're technically gonna hold them harmless because of this new standard. So what we mean by that is, like Dan had a very good slide where it shows, what your balance sheet looked like last year and then what it's going to look like, with the new standards. So, we always want to compare apples to apples. So if there is a big effect, based on these new standards, we're going to hold you harmless for that. And the schools that are going to be concerned about that are the ones coming up for renewal. So as an authorizer, we're just going to tell the story. We're going to show what your financials show what these new standards were and how it affected it, and how the changes that are under the new one. And we will not hold you to that if it really affects a benchmark, and it's a red mark on your financials. Don't worry about it. Don't worry about your authorizer. What I would advise you to do is to work now with your auditors, with your service providers, get those journal entries understood and decisions made, meaning get your finance committee involved, because setting this asset up on your books, decisions have to be made. So you really need to get your finance committees involved in this decision right now. And we're here to work with you. Everybody's in this together. We will adjust our templates as needed, and Connor's going to talk to you in a second about what we'll do there. But we're flexible. We're here, and we want to make this work. And we don't want any extra costs on the charter meeting. We don't want you to have extra audit costs and everything else because of additional reporting or anything like that. So we're here to protect the charters. Connor?
Yeah, thanks. Obviously, the next template that everybody will be filling out is the budget template that'll be due June 30th. We put one out there already, as soon as we got the new rates. What I think I'm going to do is replace that with a template with the balance sheet so that it will reflect these new assets and liabilities, just to address entering this on your interim financials. We are going to ask that you do include them, even though you have some leniency to wait till fiscal year 24. And what that will do is it'll give us some lead time to see how the new standard affects the ratios that we put into your renewal reports. And, if we do see a big difference, it'll allow us to tweak those. So if you're familiar with our fiscal dashboard, it goes in all the renewal reports. And if these new standards are going to affect some of those ratios and benchmarks that we put in the renewal reports, it'll allow us to tweak those a little bit. And like Barb said, we don't want to hold this standard against the school. So you'll see a new budget template out there. And then in fiscal year 23, the audit template will include these as well. But always, if you have questions, feel free to reach out. We're always happy to help. And just like everybody else on this call, we want to see all the schools do well and succeed.
Thanks, Connor. So just to reiterate, the authorizers prefer, including SUNY prefers a comparative financial statement, but they're not asking the schools to go back and redo the lease standard from the earliest presentation from last year. So with the slide that Dan had is the slide. It's the easiest thing for the schools and for the auditors to do. So we'll stick with that. We're not going back to prior years and restating those numbers for the lease standard, just to be clear. And even though the interim reporting is not required, SUNY would like to see those numbers so they can determine, whether it's renewal or other things that they want to see how your balance sheet's going to look at the end of the year. Right. So again, just to be clear, the school's responsible for this. We always get a lot of, the auditors will take care of it, or the auditors will do this. We really can't do it. We have to maintain that independence, but we're happy to help, and we're happy to answer any questions, but we can't do the work for you. So the school, with the help of their back office providers or consultants, can do this. We're happy to review and answer any questions you may have. Again, this is the simplest, we presented the simplest example and more typical example. There's going to be a lot more involved with whether it's prepaid rents, whether it's, I have a lease that's signed prior to June 30 and it doesn't start until after. Those kinds of questions. You can just reach out to, reach out to your auditors and reach out to your consultants and back office providers. Again, I'm not going to go through every single one of these, but this, this standard impacts. You really have to determine materiality for some of these, and you also have to, look at this only impacts long-term leases. So if you have a lease, whether it's month to month or a lease that's due within 1 year, it's not applicable to the standard. We can do the next one. I think that may be okay. Again, we discussed the month to month. Again, extensions, if it's reasonably certain, you should include that from the beginning and include it in your initial recognition when you're doing the leases. If it's reasonably certain, you should include that in there. I think that's really, I just want to save the last 5 minutes or so for just to answer some questions. I know we went through this really quick, very complicated, but I just want to open it up to the group just to ask some questions.
Thanks, Gus. There are a couple questions that came through the chat. Some of them have already been answered in the chat, but I do want to address a couple that haven't been. Dan, I'm going to push this one over to you. If you signed a lease, but it doesn't commence until September of 2023, would you record as of 7/1/22 or when the commencement date begins?
Thank you. Thank you, Michelle. You would go, what the standards say, the commencement date of the lease, it goes by the date that the lessor, that the landlord makes the underlying asset available to the lessee. So when you, I would go by, I would consider that the move-in date. So it under the standard, it goes by that. It goes by when the actual asset is available to the lessee.
Great, thanks, Dan. And that's really the same as the deferred lease liability methodology as well, that was in effect or is in effect now, that you really have to go by when you have access to the property. So thanks, Dan. And I know a question came in about recommendations for toolkits. Both Dan and Gus mentioned this. yes, we do have toolkits. We'll actually include one with the presentation materials. It's from the AICPA, but there are also lease software systems that not only help you calculate, but also provide all the footnote disclosures that are required as well. And again, check with your auditors, check with your back office service providers for help there, but there are definitely tools you can use. You don't have to create your own. And I think that's all the questions in the chat.
Michelle, do you want to, there was a question about a public, when is the school treated like a public entity? And that's when we're seeing more and more bond issues and bond payable. So you have to adopt this standard. We have to adopt it on a few entities last year, even though it's not implemented until FY23. We had to do it for FY21 because the entity had bond issues or bond payable. So I know you have a lot of clients that have that as well.
Yep. And so, yes, so you're considered public if you have publicly traded debt. So, so I did respond to that in the chat. I think I've covered all the questions that were in the chat. If I didn't, please just unmute yourself and let me know.
Well, if there are no additional questions just for this portion, I do want to thank everyone and all of our presenters for presenting today, from CSBM, AF O'Connor Davies, and Mengel Metzger Bar and Company. Thank you for putting your contact information on the screen. This is a really informative presentation. I know that there may be continued questions, so I just want to reaffirm with the people who are still online here that we will be posting the recording and the materials from today's session in our resource center. So if you want to go ahead and click on that link to join our resource center, this is always a good center to bookmark and have available to you. We will post the materials, and when you create your account, or if you already have an account in our resource center, you will get pinged when these materials are posted. So the recording, which we'll prepare shortly after this ends, and the materials will all get posted to the resource center. You can find them there. Thank you once again so much for our presenters. If you have further questions, please feel free to reach out to anyone on the screen. I'll also throw in my email address in case it's easier to forward me a question, then I will work with our presenters to get you an answer. So once again, thank you. Have a happy Thursday and have a wonderful weekend. Take care, everyone.